All right, welcome Real Estate Hustlers podcast. I'm your host, Josh Appleman. Today we are joined with Lane. Lane runs the Wealth Elevator and has invested in over 10,000 units worth 2.1 billion plus. Forbes writer, top 10 podcast host, and Amazon best-selling author. He helps busy professionals build passive income and cut taxes. Lane, if you could let the listeners know a little bit more about yourself.
I used to be a W-2 engineer and got started investing in 2009, buying little rental properties. And then in 2015, I had 11 and I stepped up to the bigger stuff as the single family homes just weren't scalable. And yeah, I think that's 2015. That's when I started to get into the syndications and private placements, started to do smaller class C, 50, 60 unit properties, because that's all the brokers are going to throw your way, right? They're not going to get the big class Bs or certainly class As. And yeah, that was kind of the start.
You started out when units were 20s and 30s a unit.
Yeah. Actually, 27 a unit, I think, here in Alabama, right? Yeah, it's a good time to get started for sure.
Yeah, yep. Well, tell us about you got into real estate. You started with single family houses. You got into the bigger stuff. What made you want to get into the bigger stuff? And then what propelled you to get in there? Did you do partnership? Did you raise capital at first? Use your own capital? Just tell the listeners, beginning real estate investors, the path to get there.
Yeah, so with 11 rental properties, I had maybe an eviction or two every single year, some kind of big catastrophe that happened every quarter. And I started to realize it became a chore, right? I mean, I was still working my engineering job at this time back in 2014 and 15, and it just wasn't scalable. And this is where I started to interact with other accredited investors, started to learn best practices that I put into my book, The Wealth Elevator. And I started to realize like a lot of these guys would be selling off their little rental properties, their starter portfolios, and then going into deals as an LP. So they didn't have to worry about the tenants, termites, and toilets, and more importantly, the legal repercussions of stupid, frivolous lawsuits. So it made a lot of sense to me, right? Like I'm sure you guys talk a lot about like economies of scale. When you get 60 more units, you get a full-time leasing agent at the property, and then you can actually hold them accountable for things as opposed to a residential property manager who is the complete opposite, who spends most of his day just talking to or driving around, right, to try to manage his 100 plus properties poorly, so only he can kiss their butt just enough so that he can sell their properties when they actually get tired of owning it, and that's how he actually makes money, right? And not off the 10% a month.
Yeah.
So that's kind of where it made sense for me. Like number one, like that's what my peer group was doing at the time, and
It's
just
interesting. You
economies of
just gave a
scale.
little hack there as far as how PMs truly operate and what they look for.
Yeah, I mean, commercial property managers are very much way more sophisticated, right? I mean, they have like 2/3 amount of the day given back to them because they don't have to drive around all the place. But like in terms of leasing, you get very granular into the numbers, right? Like, how much money do you spend on marketing? Nowadays it's a little easier because a lot of it goes through apartments.com and those major channels. Um, you know, before, we get really guerrilla marketing with Craigslist, but that just attracts the worst tenants, right? Like,
Yeah.
you don't want people from Craigslist. I mean, maybe there's some good ones out there, but generally speaking, you got some kind of strange folks out on the Craigslist world. Um, but you go to the major channels, apartments.com, that syndicates out to the masses to find, regular people. I mean, although people who live in apartments aren't really regular people, if you ask me. They got their sets of problems too, right? Just like wealthy people, I guess. But yeah, we started to do those larger units from there, and 2020 we started to develop to create more value add. But yeah, that's kind of the genesis of it, and started to learn these other tax strategies, cost segregation, real estate professional status.
Let's pause
Um,
on the development. You all got into development ground up.
Yeah, I think for us, like it made sense because we were managing and operating these assets, right? So I think that was where we had an advantage over the developers. Most developers are really horrible operators, um, because they're amazing developers, right? It's just kind of two different sides of the world. So they'll develop and they'll just want to probably dump the asset, and they are in a way distressed sellers or more motivated sellers at that point. So we kind of figure, well, if you build an asset, and why not just own it long term? Because that's the hard thing about these crappy 1960s, 1980s properties is things just break, and you can do your due diligence report, get your contractors report, but these chillers, once it gets a couple decades old, a big repair, or you may have to just replace the whole thing, and that's $250,000 right there, maybe even more, right? If you sometimes you have these problems where the chiller creates piping issues, or you just have old pipes. Now it turns into $500,000 or $1 million problem. If it didn't mess up other things on your property, right? Let's not get into the water damage and things like that. So, most people, unless, I think most people who operate, you either bifurcate two ways. You either go the direction we did, which is nicer properties, better clientele. And then, don't get me started on like Class C properties. When we take over the Class C properties back in the day, collections would be like 80%. So that means like for every 100 people, you have like 20 people just will never pay. You can set the collections, but you're not going to get anything back on that. So we chose to go to the nicer and less headaches. Like as I mentioned, some operators out there, this is not our strategy, but I mean, I think it's
What is
valid
nicer, like
strategy.
Class A, like the type that the buildings you will see brand new, ground up, or
Yeah, I would say like your Class B, Class A, right?
okay,
That
1990s
side.
vintage plus, 2000s vintage plus.
Even 1980s, right, can be
Okay, yeah,
considered as Class B. Some other people will go the other direction, which is like just the dilapidated 50% occupied. We always went for the more 90% occupied type of properties because we wanted the Fannie Mae, Freddie Mac agency financing.
yeah,
But that was also, getting back to your earlier question, why we started to develop from scratch, because now you're stepping into an asset and you don't have to, there's nothing to fix, at least for
yeah.
next decade, knock on wood, right? Or even when you're picking up on like a 1990s property, there's always, $250,000 for this, $500,000 for this, that you of deferred maintenance that you have to pick up and
Yeah.
account for.
There's always the next thing, the next leak, the next this, that. It's always, I mean, that's why you buy it at the basis you do too, or you're supposed to. You don't trade 1960s and 70s assets here in Cincinnati at 80s and 90s a door. Those are supposed to trade right now, 60, 65, and or less, depending on how much cash you need to put into the units to get them to market standard. But you got the people that do buy them for 80s and 90s mess up the market, and then they're over leveraged, and they're in the environment we're in now. What are you seeing now out there as far as assets going back, or is your all's portfolio? What's that looking like?
I mean, it's down 30% from the peaks, right? I mean, that's nobody. If they're saying that they're not having a bad time, they're lying. Or the worst part is you got guys now starting their syndication businesses who weren't active prior to 2021, 2022, and they have a flawless track record because they have no track record. I think that's kind of where, all right, now, I mean, when I look at deals these days, if it's like a Phoenix or Austin, and you're showing your underwriting for like 1 or 2% rent growth or above, dude, you're still getting, I mean, we still have assets in Arizona. I mean, you better not be underwriting for anything 2% or higher. I mean, in some places it's still negative rent growth. We even have some units where it's still negative.
100%.
Those types of markets, you had overbuilding. They get really hot and they go really cold. And right now it's the cold time. So, and not to say that they're not good deals to go into, right? To me, my whole thing is what we teach investors is how to look at the deal and throw out what the operator's saying as projected returns, and take the P&Ls and rent rolls and just underwrite it themselves and make sure that the operator's using the right assumptions. Or our process is we take in a whole bunch of deals that's out there in the ethos, then apply our own set of assumptions, right? So like for Phoenix, like I mentioned, maybe 1% rent growth to be modest, right? But I think where the opportunity is these days is more the tertiary markets, because a lot of these places there weren't any building there, so you have the linear boring growth. That said, you shouldn't be underwriting for 3% rent growth in those. You just have to assume that you're going to be holding it longer. But taxes, like I had a 300 unit in Houston that we bought in 2020. The taxes were like 150 grand. Now it's well over 400. And you add insurance doubled in a lot of these places, and then obviously the debt service.
Is the NOI supporting the tax reassessment, or is that pushing it into negative cash flow?
Yeah, I mean it's you're right at like break even, right?
Yeah.
You had to abort from the original business plan and divert cash to just kind of stay there. Um, and I think that's kind of where, but you're looking at new acquisitions today. I mean, just like a single guy buying a single family home, that's not going to cash flow for you.
Hmm.
It might have been in 2009 when I first started, but not these days. So I think you have to go into more boring markets and hold it for longer. Or
Hmm.
if you're able to get like a FHA loan, that then you're looking at like a 3%, 35-year amortization. That might make the numbers work. Or I've been taking a look at some of these deals lately where they're kind of, it was a newer property that they built with low income restrictions, and now those low income restrictions are burning off.
Oh wow.
I don't, so
So the Lura contract was what, for 30 years, and that's towards the end of it. Okay.
yeah, so you can magically bump the rents up $400, right? But
Yeah.
there's a
That's
lot of complications with that, right? Like normally when we underwrite a normal deal, anything higher than 15% rent bumps is very audacious. And again, this goes into like the investor education and due diligence from an LP's perspective. Like you may not understand like what the prices of these things are, or like how much landscaping is as a percentage of the expenses, etc. But like I think that's what's nice thing about real estate is like you can understand like if the apartment is renting for $950 a month, and they're gonna remove the low rent restrictions and now rent it for $1,500 market rate, you're gonna get a lot of middle fingers and upset people there that are probably not going to stay. So you're
Mhm.
gonna have turnover. So you better model for that turnover. And how do you do that? Well, I mean, one standard way of doing it, just easy to talk on a podcast, is like you may underwrite for the rents not either going up to that level very quickly. So like, maybe the first year you might underwrite for 80% economic vacancy, or even 60, as low as 60%. And then maybe titrate that up in year 2 or 3, right? Like that's a way of somehow underwriting for people. You're not going to get full absorption of those higher market rents right away.
Yeah, right
Um,
now you should be operating for occupancy, not for rent growth. We're not going to trade out one tenant for $100 more than that's been paying month over month on time for one that might pay $100 more, and you still have to qualify on background check, no evictions, on and on and on. It's a very soft renters market right now.
yeah, yeah. I mean, even on that's good if you're occupied, right? If you're not occupied and you're getting under 90%, a knee-jerk reaction from a lot of new investors, and this is me back in like I was under this impression back in 2021. Hey, let's just lower the rents,
Hmm.
right? But when you start to do that, your long-term repercussions of it is when you lower the rents, it's a race to the bottom. Now you just get junk tenants,
Yeah, you
and
can't
then
do that.
those now your frequency rate of them just trashing your property. So is it better to rent it out at 100% occupancy and now capture the $700 a month rent, and then now deal with their $10,000 repair bill when they trash the property and leave half of the time, or maybe more realistically 10% of the time, you do the math, right? I'll tell you, it's probably better to keep the property at 75%,
I
80%
think
occupancy.
it's more on renewals. When you're coming around for a renewal and you go to do your yearly increase, instead of increasing on that tenant and say they can't afford it, they're going to leave, just keep it the same. Write another year out. They're paying on time. Don't worry about the 3% year over year. You've got other tenants that might not be paying, and don't pick on the ones that are right now.
Yeah, I think that's certainly a strategy. But yeah, like the problem is like what happens when you don't, right? Like I think this is what a thing that a lot of operators are running into is when you're kind of behind 10 points in the third quarter. What do you start doing? You start launching three pointers, right? Or in this case, do you start just filling heads and beds?
Uh,
It's a
Honestly,
valid
that's
concern.
the difference between owner operator. Like I'm an owner operator, and all of my properties. No, we've got two partners on two deals, and I've done one syndication, never do a syndication again. But when you're an owner operator, it's cash flowing, it's good. You've got your property where it needs to be. You're not necessarily chasing the rent, the rent bumps. You're making sure the place is operating. It's cash flowing. It's stellar. I think a lot of syndicators are forced to make sure that they're pushing rents to send out the quarterly projections and reporting.
Well, I'll tell you what also is pushing them too. Their loan may be coming due, right? So
Yeah.
if they need a refinance, they need to get above that 90%. So it
Hmm.
strategically, it may make sense for them to just play the heads and beds and get over that 90% so they can refinance. But these are these are the things that are happening beneath the surface that are creating like, unique opportunities. But, as far as like even in these situations, it's tough to underwrite these deals as a new buyer with the higher taxes, insurance, and then the loans still aren't that great, right? The loan to values are still pretty poor. Um, Even if you look at something optimistically, it's just tough to pencil.
Yeah. No, and there's a lot of opportunity out there right now, but I don't think that we're. I think it's good to go ahead and prepare, gather your equity or your sources to take advantage of it, because there's going to be some great basis deals. There already are. But at the same time, it's how do you want to operate it? Do you want third party to more than anything operate your destiny, or get in there and make sure you can push the levers and build your own team out? That's the like that's the difference. The syndicators are the ones that got whacked, totally whacked, because they had third party property management in front of them. And this distressed deal we just had come across the desk yesterday, 303 units. That's exactly what happened. The third party property management is just squeezing the entire property and all the financials.
Yeah. I mean, different situations out there for sure. I would say the nice thing now that you look ahead, like the developers aren't developing, and we're not developing. We're just kind of sitting on our land right now because even when we started some of these projects, we underwrote for like 99% to go to construction, which was like 2 or 3% higher than what we thought it would be or what it was. But now you're looking at construction notes in the 12, 13%. So it's just no bueno. It just doesn't make it work, which is everybody out there, all the developers, which is why nobody's building anything right now, which, until 3 to 5 years later, you won't look back at the rearview mirror and realize like nobody was having apartment babies. So that's a good thing on the horizon is to look for in the future that you're not going to have that new supply coming online in the near
Yeah.
term.
Yeah, and nothing lasts forever. We're just in a cycle right now, but it's a good time to be in a cycle if you're making it. Bad time if you're not making it, but nothing lasts forever, and um, it's just being ready. I mean, going through the. I know when I was underwriting every deal and still do deal over deal over deal, just nothing pencils because the owner's price is still in 2021, 2022, and the cap rates aren't there and the interest rates aren't there.
Yeah. I mean, you're starting to see a little bit of meeting of the minds or the buyers meeting the sellers at this point. I mean,
Hmm.
I'm not gonna say. I mean, you can never tell, right? I mean, there's this crystal ball stuff, but I do believe the bottom of the market was in the river mirror. I mean, anecdotally, like we've have some of our properties that in early 2024 like appraised for like I think like 19 or 20, and then we get it reappraised later in the year for like mid 20s. So I do think that that's just one property in one particular market, and there is a fudge factor with these appraisals, right? But I certainly think you're starting to see that stability in the market, and whether it comes back the other way, meaning you are going to start to see that pretty standard 10% or 0.1% cap rate compression year by year by year by year. So you have a full point in 10 years. It never goes that standardly, right? But like I do think you're starting to see things come back the other way. Certainly there was a lot of disinterest from investors out there, right, who kind of got wiped out the last several years. But from that perspective, that's the sh- that's the sign that spring flowers are kind of right around the turn or already popping up.
If you could, let's give the listeners, beginning real estate listeners, some advice, some learning lessons that you've had over the years, that you would, if you knew then what you know now, things would have changed a little bit in different aspects.
Yeah, I mean, just personally, I mean, this is sort of written in blood for me. I mean, I lost a lot of money, but real estate was the way I grew my net worth, right? From 2009, buying my first rental property. I probably had 80 to 90% of my net worth in commercial real estate in the top. Um, Luckily, a little bit. I wish I would have done more, right? So that's the lesson is like, a high concentration of one asset class isn't very smart. But I also say, like, when you're a non-accredited investor or getting started, you got to concentrate in something.
Yeah.
Nobody built wealth by doing the diversified strategy, right? Like, most of my investors that did it that way, the highest they get to is like 2 mil by doing it doing it that way. The people who build substantial wealth are the ones who focus on one thing and kind of make an educated gamble on that. Um, the Similarly, like entrepreneurs, right? Entrepreneurs are putting everything into their business and it pops, and that's how they get 5-10 mil, right?
Yeah.
So those, I just contradicted myself on purpose because I'm not a financial planner. I'm not giving any financial advice here. But that's kind of the point I make in my book, The Wealth Elevator. There's different paradigms to the wealth building journey, your beginning stages, and when you become an accredited investor, then when you get past $4 million net worth. There are three different points in there, and then the strategies sort of change, or at least the way I've seen it, or I've kind of progressed building my wealth over the last couple of decades here. But I think the lesson learned is, be wary of there's different asset classes out there. The stock market is just one asset class. Real estate is just one asset class. I'm a real estate fanboy for sure, right? I still love real estate. We still look at real estate deals, but I'm a little bit more not cautious, but I'm a little bit aware of like I need to keep a big chunk in real estate, private equity, and then private credit, and low risk, low return stuff. So that would be like the T-bills and life insurance side. At least that's how I look at things for myself personally. But everybody's in different situations. So like, I'm not giving financial advice. People want to jump on a call, that's fine, right? I mean, it gets a little bit more personalized, but that's where unfortunately all you have out there is like the standard American diet, right? The sad diet of what they want you to put your money into. And I do think that is good for most people, because most people they don't have the initiative to kind of listen to podcasts like yours, Josh, and get educated. And they're not able to talk to people, right? People are such weird introverts these days, or in Japan we call them hikimoris. They're not able to do that. So yeah, if you're not able to get out from behind your computer and meet people face to face, build relationships, then yeah, I think you should just stay with the standard stuff, right?
I think FOMO is a pretty good indicator of the direction not to go. When you start seeing like the stock market blowing up, you want to be a part of it because it's getting so high, and you feel like you're missing out. That's fear of missing out. Just like Bitcoin, when it goes to 129, whatever it went up to all-time high, you start getting fear of missing out. Like just and then real estate, multifamily is just everyone got FOMO with multifamily all at the same time.
Yeah, I would say, like, if I recall in hindsight, like my investors that I stumbled upon in 2020 to 2022, the general theme, right? I mean, was, oh my goodness, real estate is on fire. FOMO, FOMO, FOMO. I want a piece of that, right? Similar to like I want to touch Neil Jensen's leather jacket at Nvidia, right? Or I want to go out in that rocket with SpaceX, right? Which I got pre-IPO with SpaceX, right, which is different, I think. But
Nice.
so maybe I'm in that rocket ship too, in a way. But just me diversifying, right? But
Hmm.
not investment advice. But yeah, I would say that like the people nowadays that are coming and we're having more in-depth conversations these days, and these guys are higher net worth. The discussion is, I already have a lot, and I need to get a prudent amount of exposure to real estate. So it's a very different theme. One guy's like, I want to get on that craps table because it's hot, everybody's winning, I want in, right? Dead man's last words, right? Like when Phoenix rents are going up 15%, 20% in 1 year, take note of that. That's
Yeah.
but yeah, good investors, they always take a look around, like what's been beat up, what's hurt. I want that contrarian point of view, as opposed to that wannabe investor FOMO style, right? Like, but it's easier said than done. That's for sure.
Yeah, absolutely. Stay disciplined and just stick your target. Have your buy box, and underwrite. Underwrite to what it'll actually afford, not necessarily what it'll afford if you do all the work. And if you raise the rents, what will it afford today? Maybe you've got add backs in the financials that you know that you don't need if you take it over, but that's different.
Yeah,
So,
yeah. But I mean, in this last correction, right, which is a bigger correction in 20 no, 2008, yeah, I guess 2008. It's been a bigger correction in commercial real estate than that.
mhm.
Um, if you were a conservative underwriter, and this is what we do with our, when we look at stuff, I try to increase the reversion cap rate, the exit cap rate, to assume that we're going to exit in a worse market. Call me pessimist, but that's standard underwriting practices that good underwriters will do. When people sharpen the pencil, what they do is they decrease that reversion cap or keep it the same.
Mhm.
So that's what we do, is like when we look at these deals, that's one of the first things we look at, like what is the prevailing cap rate for that asset class, and then what is the exit. If I see that thing going, you know if they're being aggressive, I just throw the deal out. I'm not going to look at it, right? Like, because if you were to underwrite a deal 100% return in 5 years, and aggressively with like a zero, no change reversion cap rate, and you were to normalize it for 1%, I think your projected returns would go down by like half, or at least 40%, by that big change there. But what you saw have happened is, like, take like a place like Phoenix, cap rates went up by freaking 2.5%. Like, so it's like you assume that the market wasn't going to be that strong by 1%. So you built like a 10-foot wall, sandbag wall, to assume that there'd be rains during the hurricane, but you just got hit by a 35-foot wave, or yeah, 35 foot. You can't
Yeah.
operate out of that, right? And that will happen again. So to me, this tests investors' fortitude, is like, you will get hit with a 100-year flood. You will get hit with a 35-foot wave again. If you are always looking for deals where there's a 35-foot wall, you will never do a deal.
Mhm.
Never. So you just have to assume that you're going to take some losses here, and that's part of investing. So how do you mitigate that? Well, I think you need to expand your portfolio over 7 years at least. I mean, I have some losers, but I was lucky enough to get established well before that. So we'll live to fight another day. That's for sure. But it's those investors that unfortunately all went into 2021, 22, 2023.
Mhm.
Those are guys got blown up.
Yeah. Overspent and over. Um, they were a little bit too ambitious. Over underwrote. Very cool, Lane. If a listener wants to get a hold of you, reach out to you, learn more about yourself, how can they get a hold of you?
Yeah, they can check out my book on Amazon, The Wealth Elevator. If they pick up a copy, leave a nice review, take a screenshot, and email it to team@thewealthelevator.com. We'll hook you up with the PDF version, so you can just query it in your own LLMs. And we'll also give you the MP3s. So if you're like me and can't read too well, I will read it to you. But yeah,
Nice.
if you're an accredited investor looking for deal flow, we can connect. Shoot me an email, Lane at thewealthelevator.com.
Nice. Awesome. Lane, definitely appreciate your time. Thank you.